all our clientele, and mostly to our dear guest, Laurence Monnier. Very good to see you, Laurence. How you doing?
I'm all right. Good to see you, Antonio.
Thank you. For our mid-year, let's call it, this time, 20 Minutes Coffee webcast, where with you, as usual, we talk about infrastructure, we talk about the real asset overall, so the time is still pretty, how I put it, in not a very negative way, but also not very positive. Let's say in the hybrid side, in the between, because the real asset overall, it's a very strong, let's say, asset class. The markets continue to be pretty resilient, considering all the macro situation that is happening so far, driven, by all these geopolitical events. So risks, let's put it in that way. But I'd love to hear your update regarding all this, and specifically, do you think that still real asset overall is an infrastructure, is a resilient asset class, considering all this that we are experiencing? And then we are talking about a much more a risk-on way or risk-off way, talking about the asset class. Long beginning, but now the floor is yours.
As you say, it's a long question, so I'll try to be as concise as I can, and without mute. So, as you said, there is a lot of remaining risk despite the buoyancy of the market. To take the three biggest one that come to mind, geopolitical, as you said, AI, and inflation. And if you look at infrastructure per se, it's an asset class which is relatively well positioned in this type of risk. Interest rate and inflation risk, well, infrastructure traditionally is quite heavily linked to inflation, and it's not necessarily universally true of each asset, but generally as an asset class is quite resilient in high inflation scenario. Geopolitical risk, is negative for everyone. We've seen data centers in the Middle East being attacked, and so that's obviously a risk. But at the same time, that means that Europe is really focused on taking control of all the technology it needs for its future. And when you think that today most of the solar panels come from China, most of the data centers are operated by American companies, you see really a real drive in Europe to push European sovereignty, and including in the infrastructure space. And that creates a lot of opportunities for investment. So risk, but also a lot of opportunities for infrastructure. And, this, you can also think about development of circular economy, biofuels. All these asset class will be becomes more buoyant because of this. And the third risk is AI. And I think AI is both a risk and an opportunity for everyone, including infrastructure. Obviously, people keep referring to the opportunity in the data center space. But beyond that, I think it will provide an opportunity to improve the management, both the screening of the investment and the management of the investments. And it will probably change the landscape and improve operational efficiency. So there are risks, but there are also quite a lot of opportunities, and infrastructure is pretty well positioned compared to many other asset classes in that landscape.
Interesting. I recall in our first quarter, we weren't very much putting the AI on the riskier side. Also, I recall last year when we talked about AI, many were thinking about an inflationary element of it. But of course, you mentioned about on the opportunity side of it. Why you saw this shift?
Why I saw the shift from risk to opportunities?
Well, actually, the opposite. Because in the last year, everyone was just talking about AI as an opportunity. instead than a riskier side. Now I heard your beginning, you mentioned about, you put it under the big category of risks. Why?
No, I was actually saying, sorry if I've not been clear. I was just saying that AI is a risk generally on the macro political level. A lot of people are worried about data integrity, about loss of jobs. So AI is generally in the boardroom considered as a risk by a lot of people. And what I was saying is infrastructure in that context is relatively well positioned to benefit from AI as opposed to maybe other asset class for which, I mean, it has a risk. You have cybersecurity risk on infrastructure as you have in corporates. But I think as an asset class, it presents quite a lot of, AI presents quite a big opportunity for infrastructure.
Got it. Thank you for clarifying. We're going to go a little bit deeper also later on this specific theme. But my next point that I would like to discuss with you is looks like that the mood, let's say, of the investor side, on the buy side, towards probably not only in the real asset class, but the overall asset class, because also technology. Now we saw pretty recently a big IPO that I mean on the paper was like fantastic, but then now you see what's going on the stock exchange, not very much paying off, I would say. And we are talking about, of course, SpaceX, but we are not talking about that. The mood is much more on the wait and see, no? Because as you mentioned at the very beginning, there are a lot of risks. The macro element, it's huge volatility, but markets still continue to be pretty resilient. We have like, I don't know, you name it, the one that we know that are very close to us, two wars close to us, but there are other ones. Where actually the LPs are looking for opportunities?
Yeah, it's quite interesting because you're right. The mood is pretty wait and see. I mean, you've seen the M&A market, for example, lowering in the first quarter compared to first quarter of last year, so less transaction. But at the same time, you see that infra remains attractive. I mean, the world's largest institutional investors have increased their allocation by 15% last year, so about $1 trillion allocated to infrastructure. So on the investor side, you can still see an appetite. And then the question you raise, which is really the right question, is where do they see the opportunity in this context where some people are in a wait and see attitude and are not, the transactions may be slowing down. Well, the traditional sectors continue to be active. For example, in renewable, there is an awful lot of consolidation. It started with a lot of small businesses. There is now more money being asked by the grid to connect or as deposit to connect, and a lot of developers are starved for cash. And what you see is consolidation in that market, and also a shift from the traditional maybe wind and solar to more battery storage, a newer type of infrastructure. The other hot topic remains data center. And it's going to be a continuing story, not only because we use more data, but because data centers are so important to European sovereignty. Europe has announced big investment plans, and where we saw a lot of the activity around the so-called flat market, the Frankfurt, London, and so on. We now see quite a lot of activity in secondary and tertiary markets, and that's going to drive the business. And finally, the geopolitical context is also meaning that Europe is really focused on its infrastructure, its sovereignty, and its infrastructure resilience. For example, at the start of the year, we saw the EU giving money, the EIB giving money to Poland for a road program, that is used for civil, but also, for available for military transport if needed. So, I don't want to sound too grim, but I think the events that have taken place in the Middle East have really focused the political's attention onto the resilience and the control of their own infrastructure. And I think that will create quite a lot of opportunities.
Got it. You mentioned about renewables, you mentioned about battery storage, you mentioned about digital infrastructure as the main themes, probably, no? And you've been focusing on the European side. Can you dig a little bit more on one by one this one and says to us which kind of regions, for example, on the European side, one that are much more working on the consolidation side? Well, I'm pretty sure that on the renewable side, we are talking about the southern side, that is where actually the big solar farms are staged. But what about also the data center side? Because we saw, and also as you mentioned in our very beginning, you mentioned that all or most of the data centers today are being managed by US. So probably this is just a catch-up way from the European side, but do you think that also the regulatory environment it's positive? Because we are seeing huge projects on the paper, but are they being concretely built?
Yeah, I mean, you only hear about huge projects. What I see as well in the company I advise is a lot of, it's not the 500, it's not the 100 megawatt campus, but you see a lot of projects which are, maybe smaller projects, but which are, really, I think what is driving the sector now is availability of power. If you have power connection available for, a reasonable amount, but not necessarily, a 400 megawatt connection in the next year or two, then you will have demand in this sector because people are really looking for data centers. Again, it's the best known part of the market is the big, warehouse cloud type data center. And these are, the big project that people talk about and get a lot of political either support or opposition, depending. But what you don't see is a lot of the new companies that developed that are, developing data as a service, that are operating for the ecosystems around them, and that are also, you can see an increasing trend to outsource data, not just data storage, but data processing, AI and all these activities. And there is a lot of demand for these data centers.
Got it. We're going to see, I think that also for this specific topic, it's still a wait and see. Because as you mentioned, there are different kind of sizes. No, we are not talking about the hyperscaler, correct? But you are talking about a smaller size, probably in 20, 30, 50 megawatt project on the local sphere. Another point that I would like to discuss with you, because I mean you have a huge experience also on the debt side when we talk about real asset, and now you actually been appointed as a board member of another player, but we are seeing elevated bond yields that are impacting the real estate pricing. Then there is this renewed surge in borrowing cost because the interest rates are high, let's say in the midterms, and restricted lending policies that are triggering notable borrower distress. What is your view around this specific theme, and how this can potentially affect the sector?
Well, good question. Again, infrastructure, and I think we've discussed it on a previous sector, but generally at a macro level, it's relatively well protected in the short term against increasing in rates, because traditionally you have 90 to 100% of debt which is fixed rate. It tends to be longer term debt, and if you have no refinancing risk, yes, the value of your equity on a NPV standpoint may be lower, but you don't have any cash flow stress. Where it's less true is that in the past 5 years, more companies, we've seen a trend to shorter term financing with more repayments, balloon repayments rather than fully amortizing loan that we used to have. And that opens refinancing risk for these companies which borrowed maybe in 2019 or 2020 when there was 0% interest rate and need to refinance now. But by and large, at the asset class level, I don't see any systemic shock. It just applies to these companies which either are over leveraged or have to refinance in a higher leverage. Now, what I would say, and the company I recently, I'm a big proponent and a big fan of infrastructure debt, have always been, and I think in the current context, this higher interest rate is also an opportunity, certainly for infrastructure debt, because you have a higher return. You have an equity cushion, so it's still a resilient asset class, and you have a higher return. So, as always, there's a risk and an opportunity. Certainly, we can see some borrowers, those more exposed to refinancing risk, will suffer. And obviously, higher rates, lower asset values, and this could create some, misalignment of perceptions between buyers and sellers in transactions. But there are opportunities as well, and it remains, there is no systemic risk in the infrastructure space.
Good to hear. Also because we saw in the last couple of months a big withdrawal from the big private credit players. So you are now also telling me that it's not very much focused on this specific asset class. In fact, most of them are on the technology side. So this is a confirmation. Appreciate for that. For the last couple of minutes that we have remaining, for this mid-year outlook, you are considering all that we've been talking about. Are you much more on the risk on or risk off side regarding the asset class, and why?
Well, Antonio, I'll make you a very political answer. I don't think you can avoid risk. I don't think you can be risk off in the current environment. Or you leave, you only invest in sovereign bonds, in short-dated sovereign bonds, and you have to choose your risk. I'm optimistic that infrastructure is relatively well placed for the reason I said in the current environment. And then you have investors who actually are risk on at the moment. If you take the example of, I was talking to Finnish investors, and they've been just allowed by their regulator, the pension investors, to increase their risk. So some people are risk on despite the context for regulatory reason or in search of higher yield. And then it becomes, choose your risk return objective, and then pick which risk you can manage and which risk and can be managing or you're familiar with. Don't go into, asset class that you're not familiar with. If you're more moderate on the risk, consider infrastructure debt because it's more moderate risk profile. If you're more risk on, but even within infrastructure debt, there are different risk profiles. If you're more risk on, which risk are you trying to hedge? Is it inflation? So I would say I'm generally risk neutral, but I would say it's time to choose your risk wisely.
I appreciate it. That's a very, very smart and clever, wise, I would say, advice. So stay focused where you think that you are better, where you have much more experience on. It's not the time to be cowboys. Let's leave this one to the much more experienced one. I'm pretty sure that you would say also the diversification aspect is very relevant, and go for the quality. So find that manager that is focused in good track record, I guess, no? Focus on their abilities. Laurence, thank you very much once again for this very, as usual, insightful conversation. I appreciate it. I know that you are going on vacation, so I wish you a very nice resting time. And we're gonna definitely talk again for the Q3 update.
Thank you very much, Antonio, and have a good vacation when you get there too.
Indeed, I will try. Thank you. Bye-bye.
Take care. Bye.